Hi, I'm Christian Chan, CEO at AssetMark. I hope you all had wonderful holidays. I know it's hard to believe, but 2025 is here. I tried to think of a good way to characterize my expectations for the year. On one hand, I think we'll see more of the same in the economy, which is to say above-trend growth and elevated inflation. On the other hand, policies from the incoming Trump administration have the potential to move the needle on both growth and inflation. At the end of the day, I think we'll see both tailwinds and tail risks in 2025. In summary, we think we'll continue to see above-trend growth and elevated inflation in the economy. That means a generally supportive market for equities, particularly in the US. Elevated inflation risk implies shorter duration positioning in bond portfolios. It also implies that bonds may need some help in diversifying portfolio risk, so risk control strategies may have a role in your portfolio this year. We continue to see both growth and inflation slowly slowing, but those movements have gotten even slower. In 2025, we could be stuck right in the middle of this box, which is not a bad place to be. Consensus growth estimates for 2025 call for 2.1% growth with a low of 0.5 and a high of 2.9. I know that seems really broad, but it's not unusual. There's always a subset of economists who see a recession right around the corner. I think a recession is unlikely this year. Consensus inflation estimates call for 2.5% CPI growth in 2025 with a low of 1.9 and a high of 3.8. If you look at the range of growth in inflation estimates, you could expect a pretty wide range of interest rate expectations. If we see 0.5% growth, I expect 100 or 200 basis points of rate cuts. If you get 3.8% inflation, I would expect no cuts this year or maybe even a rate hike, depending on what the growth picture looks like. Let's dig into growth a little bit. One reason the economy has been so resilient is household net worth, which we show on the left. The vast majority of Americans have never been wealthier. You can see this in the service sector of the economy. Real-time indicators like restaurant bookings and TSA checkpoint throughput continues to look really healthy. A strong job market is also very supportive. We've seen some signs of weakness, but if you look at payroll growth, we've added about 190,000 jobs on average over the last 3 months. That's just above the long-term average. Moving to inflation, we show the major inflation categories on the left. The two blue columns show headline inflation of 2.7% year-on-year in November and 3.3% year-on-year in the core. If you look at the last three columns on the right, we show that inflation for shelter, goods, and services. You see that shelter and services continues to be really high. We talked about the strength of the service sector a few minutes ago. The shelter inflation we think will also continue to remain elevated. Moving on to interest rate expectations. On the left, we show market-implied interest rate expectations for the next couple of years at the beginning of the fourth quarter in 2024 in gray and at the end of the fourth quarter in blue. As you can see, interest rate expectations moved up significantly in the fourth quarter. In that context, a 2.4% return in the equity markets is pretty impressive. I want to finish the economic summary with our current macroeconomic dials. We categorize growth as good, but pretty close to neutral. We characterize inflation as neutral, but close to good because we continue to see a slow downtrend in inflation. And financial conditions, which encompasses a number of different interest rate and market risk measures, we characterize as neutral, but also close to good because we are in a cutting cycle, at least for now. Turning to markets, here we show the PE ratio of the S&P 500 compared to the EFA index on the left. You can see that the divergence has really expanded over the last 3 years. On the right, we show earnings per share for the S&P 500 in blue and for EFA in gray. And if you look at the gray line, you can see that on an earnings per share basis, the EFA index has still not eclipsed its high, which was set just before the financial crisis. Earnings per share for the S&P 500, however, is in blue, and you can see how much more companies in the US earn on a per share basis. There are lots of reasons for this, like the corporate buyback culture in the US, but I think this chart explains why the US trades at such a high multiple compared to the rest of the developed world. Now, there's clearly a value opportunity in EFA. What we're not seeing right now is a catalyst to unlock that value, so we suggest investors tilt their portfolios towards the US. Focusing on the US for a bit, on the left, we show earnings expectations over the next 3 years for large, mid, and small cap companies. I think the 2025 estimate for small caps is a bit aggressive, which is why I see greater opportunities in mid caps and what I call the S&P 493, which is the S&P 500 minus the Mag 7. Lastly, the bond market. With elevated inflation, we suggest investors tilt their portfolios towards short to intermediate parts of the market, in case longer end yields continue to rise. The good news for bond investors is that higher starting yields provide a total return cushion. The yield on the aggregate bond index is about 4.9% today. If yields stay the same, that's the return you would expect during the year. If yields rise by 50 basis points, the price of the bonds in the index would decrease, but the starting yield would provide a cushion and keep your total return at about 2%. If yields fall by 50 basis points, the price of your bonds would increase, taking the total return to almost 8%. We show investment-grade corporate bond spreads, which are extremely low, which implies that you're not getting paid much to take on credit risk. So we suggest investors focus on quality within their bond portfolios. In summary, we think we'll continue to see above-trend growth and elevated inflation in the economy. This means a generally supportive market for equities, particularly in the US. Elevated inflation risk implies that shorter duration positioning makes sense in bond portfolios today. It also implies that bonds may need some help in diversifying portfolio risk, so risk control strategies may have a role in your portfolio this year. Thanks for watching. I wish you all a prosperous and profitable 2025.